Welcome, 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 everyone. Thank you so much for joining. Today, we're going to talk about making the jump to multifamily from single family, right? So, a lot of people start off doing the single family thing. They start with buying one single family, then a second, then a third, and they keep on going and going and going. I think after a certain time, you realize like this is a lot of stuff to manage. These are a lot of roofs to manage, a lot of individual assets to manage, a lot of different tenants to manage. It becomes a very difficult way to scale the business when you're doing it one at a time, right? It also takes longer too, right? But we're going to get into some of that stuff too. So before we go on, I want to introduce a little bit about myself and what I do and how I help people. So my name is Augustino Pintus. I am the host of Bulletproof Cash Flow. We are a media and education company, and what we do is we help people get into the real estate game. Specifically, it's multifamily these days. We're trying to help people build wealth in multifamily by either getting into their first multifamily deal or scaling into something really, really, really big. And when I was buying single families, I didn't know anything about this stuff. I had to kind of like learn it on my own. And I found that if I would have had a mentor, if I would have had a group that I can really share the deals with that I was doing, even maybe even if it was a single family type deal, if I knew what I was doing back then, I probably would have scaled a lot faster. I wouldn't have done any bad deals. I would have found the right partners. I would have known what I was looking for, right? So to that end, what we do is we do help people get into the game, as I said before. If you're interested in doing your first multifamily deal, you can go to themultifamilyadvantage.com. Go there, check it out, set up a time, jump on the phone with one of our folks, and they can help you walk you through a little bit about what the program is. But we basically have it's a 50-week mastermind as well as an online course as well. So the real value is in the mastermind itself, right? That is really how you get to learn this business, and you learn it from yours truly right here, the guy who's actually done $350 million worth of stuff. So I know what I'm talking about when it comes to multifamily. So for those that want to get into the small multifamily game, or if you're already in the multifamily game and you want to scale up even past what you're doing today, multifamilyaccelerator.com. Go ahead and check that out. And we kind of do the same sort of scenario where we have an online as well as a 50-week mastermind. But that one is geared mainly for folks that want to get into larger multifamily type deals, right? And we walk through everything you need to know on how to do those types of deals, right? So both are phenomenal. Both have a very large following, and both have students that are very happy and satisfied with how things are going. So check out either one. Set a time. There's links in there for that, and you can go ahead and jump in and of course talk to one of our coaches, right? So let me talk a little bit more about this, making this leap to multifamily. Now, back when I was buying single family, I didn't even know what multifamily was. I mean, it was one of those scenarios that it didn't even cross my mind because I wasn't focused on it. I was focused on doing the whole corporate thing. That's what I was doing, right? And that's fine. For people that are out there doing the whole corporate thing, it's okay. Nothing wrong with that. I will say this though, that if you're not focused on building more passive wealth on your own and you solely rely on that one stream of income, your corporate life income, you're setting yourself up for some potential issues, right? What I mean is that you're opening yourself up to a job loss that could basically cause big problems for you and for your family. If you're going to have to mortgage payment, you're going to have to put food on the table, you're going to have to pay bills. You want to set up other streams of income to help offset those sorts of things. And you want to also try to save on those taxes. Listen, Uncle Sam is not cutting any breaks to anybody, guys. He's not. All right. He's not cutting any breaks. What you have to do is try to offset as much as you can. And the reason why when people that buy real estate, they get the depreciation. Okay. It's like the tax system rewarding you for investing that money back into the matrix, so to speak, right? You're investing back into the United States and someone else is renting from you, right? So you're providing housing. That's one way to look at it, is you're getting rewarded for buying and investing in a property, right? So you want to think about stuff like that, right? Uh, Single families are certainly fine. You can certainly do it that way. But as I said before, scaling single family is a real pain. It really is. I mean, listen, we have a single family business too. I don't really talk about it all that much, but it'll take me what, 3, 4, 5 months to buy 2, 3, 4 deals. And that might be fine if you're going to buy 5, 10 houses in a year. That might be fine, but I can, in that same time frame, I can buy a 100 unit deal or less, actually, less time. So sure, there's more work involved in doing a bigger deal. 100%. There is. There's more work involved. It requires a very different skill set to do it. Okay. You have to know how to raise money. You have to know how to present. You have to know how to find investors. You have to know how to get the debt. You have to know how to do the inspections, all these different things. Of course, it does. Right. This is why when I mentioned earlier about the multifamily accelerator and the multifamily advantage programs, we go through all that stuff. But the upside is greater on these bigger deals. You're able to scale on these bigger deals that you just can't do with the single family stuff. You just can't. And that's where it leads you to main issues, a lot of issues. And you know what? And we're going to get into some of these issues too. Okay. Um, Now, a big part of it too, though, to all this is determining what your overall goal is. So when I was doing single families and I learned about what the multifamily thing is all about, I mean, I had no idea. I assumed that a bank owned all these big multifamily deals. I didn't know, right? I didn't know anything about syndication. I had to learn that type of scenario. So once I realized and figured out how to do it, I then got to work setting the goals that I wanted to see happen in my life. Now, why do I even mention goals? What does this got to do with anything? With single family, multifamily, blah, blah, blah. What does it got to do with anything? Well, here's the thing. Without having those goals set up and defined, you're just floating, right? You're just doing the day in, day out type scenario. And you can't, I mean, you can do that, of course, right? There's people that do it all the time, but you're not living on purpose. And what I mean by living on purpose, meaning you define a goal and you're chasing after that goal relentlessly, focused on one or two things, right? The way that I do it is I have a vision board. I look at the vision board every day, keeps me on target, and I write out my goals, right? That's a very important part of what I do, and it helps keep me focused. It helps define the vision, and it helps me follow the steps necessary to get to where I want to go. And that's why when I was doing single family and I thought, hey, it's not bad, I guess, get some passive income, a few $100 a month. Okay, wow, that's great. It wasn't enough for me. I wanted to have more passive income to eventually offset entirely my W-2 just in case something happened, right? So uh, that's the thing. That's really why you do this kind of stuff. This is why you invest in real estate. Multifamily is one way to do it. We also have net lease. Net lease is another. It's a great passive way to do it. It's a risk-adjusted return, but you know what though? On a net lease, it's a very different type of asset. You get that steady return, right? Every single month, some monthly return, right? That we offer to our investors, and very different asset classes do very different things. So that's why when I mentioned setting up your goals, determining when you consider how much income you have coming in a W-2, if this is what's going to be your bar, for instance, where are all your points of income coming in to help offset any potential issues in your W-2, right? That's how I think of it. Not everyone thinks of it that way, but I worked in the W-2 life in corporate for a very long time, and I can tell you that that's the way I think about it anyway, because you never know when your number is up working the W-2, right? So anyway, let's get into the specifics about how to make that leap from single family to multifamily. Okay, there's 5 big differences that you need to know when you're getting into the multifamily game. Okay, the first, there's a big difference in the numbers. Okay, when you're talking about single family, as I mentioned before, single family is very simple to look at, right? There's projected rents, there are comps. You have to look at the comps in the local market. You have to look at You're looking at one parcel, you're looking at one tax bill, you're looking at everything is just one deal, right? You have to lean on the neighborhood to tell you if you have a good deal or not. Okay. With multifamily deals, it's a little different. Okay. There's numbers in that aspect too, but the greater number of units they have in that deal, the lower the risk that deal is, up to a certain point, of course. When you're talking like 500 units, it's a whole different scenario. That's another discussion. Let's not talk about that for a second, right? Let's talk about your typical 100, 150, 200 unit deal. Okay. When you're talking about multifamily, you're looking at rent rolls. All right, this is the actual who lives there and what are the rents they're paying, and what sort of concessions, if any, and how much earnest money they might have put down, and or security deposits rather, how much the security deposit is and such, how long they have left on the rent. Like that's what a rent roll is. You have the NOI, net operating income. You have the balance sheet. You have the financials. You have maintenance costs. How much is spent on maintenance? What's a vacancy at in these types of assets? Are there any reserve funds that might be there that maybe the lender might have held back when the asset was first acquired from the individual you might be considering buying from? Then you have economic vacancy and physical vacancy. They both say vacancy. However, two very different vacancies here, right? Physical means, yes, it's 92% occupied, which, oh, wow, that's great, right? Well, no, of the 92%, only 85% actually paying. That's your economic vacancy, right? That means you have a bunch of deadbeats living at that apartment that aren't paying your rent, okay? And then you have to deal with all that. Which could be a problem. They have IO. We have IO meaning interest only. Some of these lenders on these bigger deals here, they will give you interest only type of payments, right, on these types of deals, and you can just get away with paying interest only for 24 months, 36 months, whatever. These days, the IO is still available on many deals. It just depends on the lender, right? Different lenders like different types of deals. You have a broker's pro forma. All right. So if you're looking at a pro forma, let's say you go to LoopNet, you download something, right? And the broker will put together what they believe the numbers are going to be. You're going to look at the expense ratio and you're going to realize it has a 30% expense ratio. Listen, no C-class asset will ever have a 30% expense ratio. Mark my words, won't happen. Just doesn't happen, guys. All right. I don't care what they say. It just doesn't happen. All right. The reason why I'm so confident about that is because the C-class asset is typically an older asset, and these older assets require a lot more maintenance. And with a lot more maintenance comes a lot more money that's spent on it, thus driving down your expense ratio, right? That means when I say your expense ratio, that means like say 30% expense ratio. That means of how much income, how much expenses. If it's 30%, it's probably not good. At best, I find maybe 50, maybe. That's a big maybe, right? Depending on, again, when it was built, where it's located, what the local demographic might be, that kind of thing. It's also going to drive your insurance costs, which insurance has been creeping up tremendously these days, especially if you have an asset in Florida. Oof, insurance has exploded down there, right? So these are the types of things that you need to understand before you do a deal, right? So, because here's the thing, in multifamily, it's run like a business because it is a business. There is a balance sheet. There's financial statements. There's all these things. It's an actual business, and it should be run like a business. Operations is absolutely key. On single family, yes, you can run it like a business when you have 100 or 200 of these houses, but you're doing a whole lot of work to run 200 houses versus the work required to run 200 units of a multifamily asset. Two different types of deals, right? And we'll get into that here in a second, okay? But all these things I mentioned before, rent rolls and financials and NOI and all that stuff needs to be accounted for. Okay, you need to know what all these things mean. You need to know where every single dollar is going. If you're going to rely on any type of projections from any broker, it's like, well, first off, you don't rely on any projections by any broker, right? You chuck that out the window and you put together your best projections you possibly can, along with if assuming you're in that market and you know that market very well, you're also leveraging any partners or anybody else that is very, very familiar with that market. Never, ever, 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 ever try to do these types of deals on your own without knowing the market. The market is absolutely key. How many jobs are coming in? What is the average income? Things like that. Okay. The crime stats, all that stuff. Okay. These are the types of things that you really need to know and understand when you are doing these types of deals. Okay. To try to do it on your own, if you don't know a market, you're brand new to it, is a mistake. Now, doesn't mean you can't start practicing. You can learn how to underwrite deals. That's what I often tell people a great deal of that. If you really want to learn this business, start underwriting the deals. Pick a market, underwrite every single deal you can possibly get your hands on. Nothing wrong with doing that. There's no harm in doing that because it'll force you to learn the market, learn the numbers, learn how to apply the numbers. Look to see how many of these bad broker documents there are out there. And no offense to my broker friends out there. Okay. We all know what's up. It's all right. It's all right. But it's important that you know how to underwrite deals. And I would suggest practicing as much as you can, as much as you can. You got to know the terminology, you got to know the language of real estate if you're really going to do this in a serious way. Now, here's the thing. If you are trying to get into this business and you reach out to a broker and you start asking them for some of this information that may not be on LoopNet, okay, they'll deem you a newbie if you can't speak the language. Oh, it's a newbie. No idea what he's talking about. They'll hang up on you. Okay. And they'll probably never talk to you again. Right. So if that's the case, go ahead and download. There's a free ebook. Okay. Guide2brokers.com. Guide2brokers.com. Go ahead, go there, download the ebook, totally free. Check it out. It talks you through how to talk to the brokers, what questions to ask, what to study, how to even dress. I even cover all that too in that ebook. All right. Totally free. Go ahead and download it. All right. And let's go through the second thing, paperwork and timeframes. Okay. Listen, when you're doing a bigger deal, yes, it does take more time, right? If you're doing a 6-unit property, yeah, there's due diligence, there's work to do, right? In terms of understanding how that deal's put together, right? There's more paperwork when you're doing a 6-unit deal over, say, a 4-unit deal or a 3-unit deal. Why is that? Well, because anything greater than 5 units is considered a commercial loan. Commercial is 5 units or up. The lender will require more information. So you need to break down all the current leases, evaluate the rent rolls, look at the repair estimates, understand the small stack of paperwork that's involved. When you're looking at the leases, look at where all those individuals are working. If all 5, let's say you're looking at a 6-unit, and all 6 of these people happen to work at the exact same place with the same manager, something's fishy, right? These are minor things, but these are things that'll save your hide if you don't look for it. You got to look for stuff like that, right? These are the things that we look for when we're putting our deals together, right? So it's important to do that. Now, as you're getting to bigger deals, the paperwork is substantial, right? There's more work to do. However, when you do that more work, okay, it takes longer, of course, usually to acquire a bigger multifamily deal these days. It used to take 30-day due diligence, 30-day to close. That's what it was before. I think that past 2020, it's now taking a good 45, and realistically, of course. I think the days of the 30-day look, 30-day close are over. And the reason why is just because nowadays it just takes longer to get the underwriting done, to get the third parties done. The third parties are, you have to get environmental checks. You have to get all these other things that are related to the deal that go into the bank's underwriting of the asset. Okay. And these are the types of things that have to be done up front, right, by the lender. So if you don't have that, it takes longer, right? But that's the thing though too. We're talking like 3 months here. So 45, 90 days. Okay, great. 90 days. That's still not bad. But if in 90 days, in 3 months, you can close a large deal in a hurry, of course, right? In that same 90 days, how many deals can you close? How many single families can you close in that same 90 days, right? It takes you longer to get to that number, to get to 200 units. Whether it's 100 units, by the way, 150, 200, 250, doesn't matter. 300, we've closed 300 units in 45 days, right? Single families, you can certainly do it, but it's one single family or two or three or five or seven. All right, great, whatever. It's you're not going to close 300 of them because you have to underwrite every single deal individually because it's the nature of how they are, right? In single families, the single family individual asset is appraised from the sales and the listings of other assets that are right nearby. So if you think about it, you don't really have true control of that individual asset. Other people are driving the value of your property, of a single family, right? So you really have to believe to a high extent that you're going to be all right in terms of what the income is going to be and what in terms of where you can charge for rents, right? So that's probably one of the bigger things, right? In single family, it does take longer because of that alone, right? So in multifamily, it's a little different. In the multifamily world, you're talking generating value. When you generate NOI, net operating income, the bottom line number, how much money does this monster put off? How much money does this building put off? It's a business. Businesses are judged by the value and the dollars they create, not by comps, primarily anyway, right? Not by comps. Comps certainly may come into play at some point, but it's largely based on the value, the cash that they generate. So the cool thing about multifamily is that there are many things you can do to drive the NOI, to increase the value. That's why you might hear the term value add. Well, the value add is how much value can you bring to this asset to make it worth more money and bring the value up. And that's on you and your team to do that. On a single family, yeah, you can do that kind of thing, but eventually, I mean, there's only so much money you can pull out of a single family or even a group of single families, because again, that's largely going to be dependent on what the neighboring assets are valued at. That's the biggest part of it, right? So that's primarily what it comes down to when it comes to doing the single family versus multifamily in that aspect, right? So when you're considering that, you usually, when you're doing single families, you can use your own money. You can get hard money to close those deals as well. You can certainly use hard money to close those bigger monster multifamily deals too. Certainly a lot more money to do that, but you can do it. It can be done, right? So, but again, I think that there's a lot more hard money guys on the single family side, just because there's more of these units available, right? So if you ever do need to get your hands on hard money, you could find them to a large extent at your local RIA. If you ever go to the RIA, Real Estate Investor Association, right? Just go there. I'm sure you once you network a little bit, I'm sure you'll find someone that's a hard money lender there. Okay, I do not recommend trying to find them on Facebook or whatever. A lot of scammers out there. I'm not saying you can't find them. I'm just saying, just be wary if you do, right? Like, make absolutely sure that they're for real. I would rather just eliminate the whole scenario and just go to a RIA and network with other people and get the lowdown from other folks that might have used that lender previously. That's probably your better bet. Okay, number 3, more capital. As I said before, there's a lot more money involved in doing a bigger deal. All right, there is. When you're doing a small deal, you have expenses, right? But it's one small deal, right? And you have your washer dryer, you have your furnaces, you have a roof. Oh, great, that's super. When you have a commercial deal, one big roof with a bunch of units underneath it. Okay, it's one big roof as opposed to with a lot of units underneath it with all those different things I just mentioned, versus one roof with only one of those things of each, or two of them even, right? So you're spreading that risk out across multiple units And when you're spreading that risk out, banks seem to like those types of deals, right? They like to invest in deals that uh, that require, how should I say this, doesn't put their money at risk. Okay, so I would say that for many new investors that are getting into this game, one of the things that they sometimes do is they get in with not enough capital to do everything properly. Okay, aside from the capital that you need to raise to acquire the asset, we'll get into that in a second. The more important thing is after they're in the deal, they think they're going to float the repairs that are necessary from the rents that they're getting. This is a huge, huge mistake. A lot of people do it. Okay, the problem with that is it very rarely goes as planned, because sometimes the expenses that you planned for end up being higher than what's normal. Okay, or higher than what you planned. Um, that's usually what happens, and it's a cause for problem, because it also slows down the improvements. And what I mean by that is that, let's say for instance you had all the capital to fix 10 units. Great, you can deploy all the money all at the same time and fix all 10 units and go. But if you're going to try to do onesie twosie, you're slowing down the whole development of these 10 units by doing two of them, trying to get an extra $400, 500, $600 a month from each one or whatever. What are you going to do with that? You can't do anything with that money. It's not enough. It's not nearly enough to turn the other units, right? It's a bad formula. Bad formula. This is one of the biggest things that many newbies do when they're getting into this game, is they don't raise enough money to get into that deal to fix it properly. Okay, so this is why I don't recommend doing that. Okay, when you're putting a deal together, what you're doing is you're raising all the money to do everything that you need to the asset up front. So we did a deal once. It was a little 96 unit deal. We only needed to raise at the time like $600,000. It wasn't that much, The back then, we were talking years ago, like lenders are giving 80% leverage, and they were doing 80% leverage. You only need 600K to close. It was great. It was a great deal. It was a super deal, right? We ended up raising 1.3 million because we wanted to change out the boilers. We wanted to change out some of the air, not the air. Geez, what am I thinking? The water tanks. We wanted to change out a bunch of other things, right? Do some other repairs, upgrade some units, things like that. That was part of the original plan. So we raised the 1.2. We still hit the return targets just fine, but we went in with that in mind up front. We created the budget going in, raised all the money that we thought we would need to get the deal done, right? And improve the asset. That's ultimately what it is, right? That's the proper way of doing these types of deals. That's the proper way, right? So basically what that means is that going in, doing your inspections, get a feel for the condition of everything, making sure you know what you're getting into, and then whether you're going to renovate the entire units, whether you're going to renovate just certain aspects of the units, create a budget, create a list, and then you've raised all that capital that's needed. Okay, so it's a great way to really start planning for getting to these big deals. Of course, then it comes down to raising the capital that you need from friends, family, other folks, and I can go into that here. It's a lot to go into, so I have a downloadable for you on that, Bulletproof Guide to Raising Capital. Go ahead and download. It's guide2capital.com. Go ahead and download that. It's if you can just go there right now, or it'll be, if you're watching the recording, we'll also include this link, and all the other links I mentioned will be in the comment section. Okay, so go ahead and grab that. Okay. Number four, larger team. All right, so if you're doing a bunch of single families, might be fine for you to do single families on your own, right? Maybe you can manage 5, 6, 7, 10 units of these things, right? Maybe you can. Maybe you can manage even 10, 15 of them, maybe. But at that point, it becomes a real pain in the butt to try to manage this on your own, right? Because now you got to find, you got to try to manage all these different aspects, these different variables of these types of deals. And typically, a management company charges more money for those types of things, right? Usually, it'd be about 10%. Um, the way I see it, guys, you can manage those types of smaller deals. Usually I find that if it's up to like say 15, 16 units, whether it's multifamily or single family or single family homes, you could probably do that on your own. Okay. If you're going to try to do multifamily like that, again, it's probably comparable. If anything, it might be a little easier in multifamily to manage 16 units because everything's under the same roof, so at least you have to just go to one place if you ever have to, if you're going to do it yourself, or if you're going to hire a handyman, again, one place as opposed to sending a handyman to 16 different places. It's a real pain, right? The thing is that if if you're in a bigger deal, you're going to have a larger team to help you run that deal. That's the point here. Okay. There's what I call the killing zone. Let's talk about the killing zone for a second. If it's between, say, 2 to 16 units, you could probably do it yourself. If you have 70 units and up, you can hire a property management team, bring on a property management team, and get all the other folks that are involved with the deal, your attorney, your CPA, all those folks to help you with running a substantial asset. But here in the middle, right, 17 units to 69 units is your killing zone. What do I call it the killing zone? I call it the killing zone because it's too big for you to manage personally, and it's too small for a property manager and the team to care. These are primarily where properties run into problems, right here in the middle. The money is also more expensive because the banks are aware that these assets are higher risk. That's why they charge more money for that money, right? Makes sense. So the team is everything in this deal. When you're doing multifamily, the team is everything. Sure, you could do small deals. You could do a bunch of 16 single family homes and you could do just fine. You can buy and sell and trade these things up as you go and live a very good life. Nothing wrong with that, But if you're going to have, if the goal here is truly to have some sort of passive income or as passive you can possibly get, you have to buy it right, obviously. But then you have to have a good handyman, a good accountant, possibly access to a good attorney to get rid of anybody that decides they're not going to pay now for whatever reason, things like that. And these are the types of things that you kind of have to plan out. And when you have a larger deal, a lot of eyes are on it. The lender's keeping an eye on it. The brokers are keeping an eye on it. The management team's keeping an eye on it. There's a lot of vested interest in here, right? So this is why I like the bigger deals, right? You can also get partners involved. Partners, if you line yourself up with a great partner that's supportive and wants to help and has the same goals as you in terms of building wealth and getting passive income, they're going to want to do a bigger deal. That's what they want to do, right? No one's interested in doing a whole bunch of single families, right? They're just not. They're harder to find those types of guys, right? So it's everything starts with getting a team together. All right. The team is what matters. The team is where you see success in these types of deals. Okay. So it's a very important aspect when you're considering putting together your team. Okay. And I might talk about teams. I'm quite sure I talk about teams in the broker guide, guide-to-brokers.com. So go ahead and download it, check it out. Because one of the things that the broker will ask you is who's your team? Who's your property manager? They're going to ask you stuff like that, right? So it's important that you start working on that important aspect if you plan on getting into the real estate game by any stretch, okay? Number 5, the last thing, due diligence. Like I said earlier about single family, it may only take a couple of hours, few hours to do research on a single family home. It doesn't take that much. You're looking at the comps, you're looking at, you go visit the property. Typically for a rental, if it's a single family, generally speaking, 1,000 to 1,300 square feet is probably the target. I like, 1.5 baths, 3 bedrooms is generally what I'm looking for when I'm doing single families. And it's not that hard. There's not much space to look at, right? It's quite easy to do. On a 4 unit deal, time will be extended, right? There's more stuff to look at. More so, every think of that single family multiplied by 3.5 times. Why 3.5? Because the roof might be the same, but some of the insides you have to change up. Maybe you have to replace the floor, maybe you have to paint, change out doors, whatever. These are the types of things that matter, and it extends the time, right? The bigger the deal, of course, the more due diligence is required. Hence, on a commercial deal, you're talking 30, 45 days to do due diligence versus a couple of hours, a few hours to do it on a single family, right? And then you start going back and forth with the real estate agent on how much you want to spend for it, right? So it's one of those things that due diligence can be extremely tedious when you're doing a big deal. They really are, because there's just so much involved in a big deal, right? It's not easy, but it's extremely necessary. You have to really commit to putting in the work and treat each unit almost as if it's its own single family home. Like, that's a lot of work, especially when you have 300 units to go through, right? Not only you have to do the physical part of it, the physical part of the due diligence, meaning condition of the flooring, the walls, the doors, the roof, the brickwork, whatever. There's a financial due diligence as well, right? Do the numbers make sense? Does the rent roll line up with the financials? Does that line up with what's in the bank, right? Because usually you ask for bank statements. Sellers aren't really big on handing over bank statements. They get a little itchy about doing those sorts of things, right? Uh, we always ask for them. But it's one of those things that when I see that everything lines up properly, right? Everything all fits together. Fannie, Freddie, they'll ask you for bank statements for sure. They will do that. So you have to make sure that when you're doing your due diligence on your multifamily, that everything lines up. And you're looking at the leases, like I said earlier, like if you have a whole bunch of people living in the asset, are all the leases matching up? Are the leases matching up? They all work for the same guy? That's suspicious, right? Very suspicious. Um, People will do that kind of stuff, by the way, right? Or they put heads on beds. They'll just put somebody in there, and they don't even have a job. They're just someone standing there, in an empty building. We did a walk once. Oh my God, we did a walk once, and we were walking through a building, and we were doing like a pre-inspection, and there was just a person literally standing in an empty room saying, "I just moved in. I'm here. I am just standing there." It was bizarre, right? Fortunately, we didn't go through that deal, but because we got bugged out by that. But yeah, that kind of stuff happens. So it's one of those things that you really have to have, in my opinion, experience truly helps. Partnering up with people that have done this before, extreme help for that, for sure, right? Because for someone who's done a lot of deals, I've seen a lot of stuff. Okay, so that's part of the reason why when you're in a mastermind and you're sharing some of these experiences, you kind of like it's bizarre because you only read about this stuff, and it actually does happen for real, right? So like I said, the key here is to try to build success when you're doing this type of business, right? And the way you do it is to partner up with other people, learn the business, learn how to execute on the business plan that you define up front, and of course, partner up with great people that kind of help you with what you need to do to get that deal done, right? So that's one of the key things. I would, you know what? I have one more bonus, thing that I want to share with you too about single family versus multifamily, and that is the biggest mistake that many people make is they'll throw out these super low ball offers. Ridiculous, stupid. Don't ever do that. Okay, I'll tell you why. Okay, let's say for instance you find a deal. Okay, You reach out to a broker, he's got a 10-unit deal, it just hit the market, the seller's asking $800,000, you run your numbers, and you're okay with all the information, you're okay with the location, you like the demographics, and then you submit an offer at 675. Okay? You like the deal $800,000, you're fine at $800,000. As a matter of fact, 800K, the deal might actually pencil, might actually be okay, right? Here's the thing. You start doing this kind of lowball nonsense in your market, the brokers love to talk. Okay, yes, there's a competitive nature with the brokers. All of them, they all work for different companies. There's a competitive nature. All right, just that's fine, but they all talk. If they mark you as a low baller, if you're like the low baller guy with the brokers now, and you're known as a low baller, you're never going to pick up a deal. That's part of the problem, right? So usually if you stick with 90% of asking, if you can't even get to that number, chances are you're not, it may not work, right? But if you're okay with whatever they're doing, take the deal. If it fits with what you're looking to do and the number is not out of line and it makes sense, you may have a deal on your hands. Not every single person that puts an offer or puts a deal out in the market is trying to rip people off. Not every single one. And sometimes you run into a good deal. It does happen. Okay. But for the love of God, don't ever, ever, ever get blackballed into being a low baller. Because if you do, the chances of you trying to pick up more deals in that market is very, very tough. Okay. So don't do that. All right. So those are the 5 plus the bonus thing. I know we covered a lot of stuff here today. I don't see any questions. If you guys have any questions, by the way, probably should have mentioned that. If you guys have any other questions, put them in the chat there. But I don't really see any questions in here. I'm going to check it out here really quick. No questions here. All right, well, good. Listen, if you're watching this recording afterwards, okay, go ahead and comment on YouTube or Facebook or wherever this is, wherever you're watching. Go ahead and comment, okay, and leave your question there. Well, someone, either myself or someone, would answer. We're always looking to reach out. And again, check out those links I shared with you guys. Totally free information. This information here is totally free. If you like what you see, by the way, subscribe on YouTube. Do me a solid. It helps us out. It helps us the channel. It helps us keep producing great content like this for you guys. This is why we do it. Okay. And like I said, it does help us out. All right. Well, I guess there's no other questions here. So thank you so much for tuning in, guys. I greatly appreciate it. And I'll see you guys next week. If you want to, by the way, when you do sign up for those ebooks there, you'll get an email from us with upcoming webinars too that we do, our upcoming trainings that we do. So by all means, go ahead and sign up regardless, because I think it'll be a good way for you to stay in tune with what we got going on. All right. Thanks for tuning in, guys. Take care.